Hey there, financial explorers, and welcome back to the channel that helps you navigate the exciting and often complex world of market mechanics. Today, we're diving deep into a specific stock that just popped up on our hard-to-borrow screener, presenting a unique case study on what can happen when supply and demand dynamics collide in the short market. We're talking about ATPC. Before we get into the specifics, let's make one thing crystal clear. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/ticker on screen. Our spotlight today is on ATPC. This is a microcap company for which detailed sector information isn't readily available. Now, looking at its recent price action and volume might seem a bit counterintuitive when we're talking about a hard-to-borrow stock. ATPC has seen absolutely no movement recently, plus 0.0% today, plus 0.0% over the last 5 days, and even plus 0.0% in the last 30 days. And the volume? A striking 0 shares traded today, with a 30-day average volume also at 0 shares. This indicates an extremely liquid situation, which is a critical piece of the puzzle we'll discuss. Despite this dormancy, our internal composite squeeze score, which weighs factors like cost to borrow and float, still gives ATPC a score of 49.2. But the real headline here, and why it caught our attention, is its staggering cost to borrow. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB? In simple terms, when someone wants to short a stock, they first have to borrow shares from existing shareholders, typically through a broker. They then sell those borrowed shares, hoping to buy them back at a lower price later and return them to the lender, profiting from the difference. The cost to borrow is the annual fee that short seller pays to borrow those shares. It's essentially a rental fee. Why does it matter? A high CTB is like a flashing red light for short sellers. It indicates that the supply of shares available to borrow is either extremely low, or the demand to short the stock is incredibly high, or both. And yes, these fees can easily exceed 100% annualized, sometimes even reaching hundreds or thousands of percent because the rate is often determined daily and compounds quickly when demand is intense. Why this stock is hard to borrow right now. Now, let's get back to ATPC. Show CTB data on screen. This stock is currently showing an annualized cost to borrow fee of a mind-boggling 677.2%. Let that sink in. Short sellers looking to bet against ATPC would be paying nearly 7 times the value of the shares per year just to hold their short position. This isn't a typo, it's a reflection of extreme scarcity. While we don't have current data on the exact number of shares available to borrow or the CTB momentum, we do know that ATPC has an estimated float of only 0.5 million shares. That's a tiny number. A small float means there are very few shares circulating in the market, making any kind of buying or selling pressure, especially short selling, have a disproportionately large impact. In ATPC's case, the 677.2% CTB, despite the current zero trading volume, signals that if any short interest were to materialize, or if any shares were sought for shorting, the cost would be astronomical due to the incredibly constrained supply. It's a testament to how illiquid and difficult to access this particular stock is for shorting purposes. Squeeze mechanics explained. This brings us to the concept of a short squeeze. Imagine this scenario: short sellers have borrowed shares of a company expecting the price to drop. But then, for whatever reason, it may be good news, an unexpected catalyst, or simply a surge in buying pressure, the stock price starts to rise. As the price goes up, short sellers start to feel the heat. Their losses mount. To limit those losses, or to avoid those massive cost to borrow fees like the 677.2% we see with ATPC, they might be forced to cover their short positions. Covering means buying back the shares they initially borrowed. This act of buying back shares adds even more buying pressure to the stock, pushing the price even higher, which in turn forces more short sellers to cover, creating a rapid upward spiral of short squeeze. It's a vicious cycle for short sellers, and a potentially lucrative one for long investors who are already in. However, it's crucial to remember that a high CTB does not guarantee a squeeze. It can also mean that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay those exorbitant fees to stay short. Dilution risk check. One critical factor we always evaluate when looking at squeeze potential is dilution risk. Dilution happens when a company issues new shares into the market, often through secondary offerings. This increases the total number of shares outstanding, effectively spreading the company's value across more shares and usually driving the share price down. Even if a stock has a high CTB and good squeeze potential, significant dilution can completely offset or even negate that potential by flooding the market with new supply. For APC, we ran our checks and found no recent diluted SEC filings like SMINUS1, SMINUS3, or 424B in the last 90 days. We also found no recent reverse splits in our look-back window. This means that, at least recently, a company hasn't added to the share count, which is a positive sign for any potential squeeze scenario should one ever develop. Let's take a quick moment for a very important reminder. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, given APC's unique situation, the staggering 677.2% cost to borrow, its microcap status, an incredibly small estimated float of just 0.5 million shares, and literally zero trading volume and price movement, what should we watch for? The key with ATPC is volume. While the current situation is dormant, the underlying conditions are extraordinary. Any significant increase in trading volume, however small, could have an outsized impact on the share price due to that tiny float and the implied difficulty of shorting. Chart with zero volume, even a small uptick in buying interest could cause rapid price appreciation. Keep an eye out for any news related to ATPC, any sudden changes in volume, or any price movements, because these signals, in a stock with such extreme hard-to-borrow conditions, could be the catalyst for something bigger. Our composite squeeze score of 49.2 tells us this isn't an immediate, imminent squeeze alert, but is certainly a stock with underlying mechanics that warrant attention. ATPC presents a fascinating case study in the world of hard-to-borrow stocks. It's a stock where the cost to borrow is screaming red hot, but the current trading activity is ice cold. This paradox highlights the potential for volatility should market interest ever pick up. Remember, high CTB doesn't guarantee a squeeze, but it certainly puts a stock on our radar as one with significant underlying tension for short sellers. Always stay informed, always do your own research, and always understand the risks involved. If you found this deep dive into ATPC insightful, make sure to like this video, subscribe to our channel for more unique market insights, and hit the notification bell so you don't miss our next breakdown. And let us know in the comments below, what other stocks are you watching that are hard to borrow? We love hearing from you.